Well, hello, everyone. Welcome to your Daily Five. I'm Joe Duarte, your host for today's show. I'm the founder of Joe Duarte and the MoneyOptions.com and the author of the fourth edition of Options Trading for Dummies, just released yesterday. And thanks to you, it's already #1 in the new releases on Amazon.com. If you want to have a copy, please get one and help me push it to #1. The publishers like that, and they let me write another one. Also, the Everything Investing in Your 20s and 30s. So if you like what you see today, please consider a free trial to my website, Joe Duarte and the MoneyOptions.com. Today, I want to talk about controlling your portfolio in volatile markets. And when you're in a bull market, it's all about momentum. And you certainly don't want to fight the Fed, don't want to fight the market's momentum and the dominant on the ground trends. You stick with those strong sectors, take those partial profits and 20% gainers, never let a winner turn to a loser, keep those sell stops nice and wide at 8% so that the market doesn't stop you out too soon. And you're always looking for new stocks. This is a little bit of a different market now. And so in uncertain markets, you have to change your perspective. So you want to manage that risk instead of chasing that momentum, because momentum in a crazy market can be fleeting. You don't want to fight the Fed, though. Remember, the Fed has now told us that they are going to start tapering the QE, and that's just as good as starting to raise interest rates. The market hates that. So you want to not fight the momentum, the dominant on the ground trends. Right now, it's very choppy and scary, so you want to be careful. So instead of chasing momentum, you want to focus on capital preservation. And that means that having more cash than usual is good. Sure, it doesn't pay any interest, but at least you're not losing money and making crazy trades. Broaden those sector horizons. If you're used to trading tech stocks and momentum stocks, you might want to look elsewhere. And I'll have a few areas of the market that might make some sense if you looking to go long. Trading those small lots. If you're used to trading 500, 800,000 share lots, you're going to get hurt when those stocks go down a couple of bucks. And so you might want to trade in smaller lots. Shorten those time frames. If you're lucky in this market and you get a nice pop, you want to take those profits a lot quicker. So instead of hanging around for a few weeks, a few days, a few bucks, not a bad idea. Again, never let a winner turn to a loser. Keep those sell stops now at no more than 3 to 5% instead of at 5 to 8 to 10%. Because the key here is to survive another day. So first thing we want to do is look and see where this market's going. Of course, we know the chaos zone is bad. The edge of chaos is where things get just right for stocks to pop, but they can pop down too. So we're still in the complexity zone, which is good. But, this advanced decline line is just looking terrible these days. In fact, over the last few months, not very good, moving sideways with a slight downward bend. Right now, we're fighting to stay above that 50-day moving average. And, if that gets broken like it did here and here, we can have some trouble. So you want to be real careful. Where is this market going? No one knows. But if the Fed does pull the trigger aggressively, it's probably going to go down. And so this time's a little different. And why is that? Because the bond market is taking the Fed seriously. Now, look. Here's the S&P 500 and the NASDAQ 100. You look at those bond yields. This is back in 2020 when we had the huge COVID scare. Bond yields collapsed, the stock market collapsed. As soon as the Fed started putting money in the markets, the market took off. And bond yields took off too, but look, S&P 500, NASDAQ 100. That's because the Fed never said we're going to stop this QE. As soon as they said they're tapering, bond yields go up, stock prices go down. And let me tell you, that is a recipe for disaster because it's no longer everything is going up at the same time. So what do you do about it? Okay, let's look at our first method here. You look for stocks with relative strength. That sounds cheesy and simple, but if the market's going down and your stock's going up, not a bad idea to be in it. So look for that relative strength. And here's a stock called Continental Resources, which I own and which is one of the stocks in our portfolio, Joe Duarte and the MoneyOptions.com at the moment. And it's a shale oil stock. It's a fracker. Stock has taken off significantly as the market has gone down. That's relative strength. Okay, that's accumulation distribution. That's unbalanced volume. That's looking good. That's ROC, that's above 0, which is good momentum. That's your RSI. It's a little bit overbought, but it's not below 50. And certainly you want to compare that price to the S&P 500. It's going up. S&P 500 has been going down, relative strength. Second thing you want to look at is income potential. Does a stock pay dividends? And if so, is it in a sideways accumulation pattern? Then you can sell a call option. Again, remember, calls are best sold with less than 45 days to expiration, so time value helps you. And you want to look for that sideways pattern so you don't get whipsawed and get stopped out of that buy right situation. So here's Gilead Sciences, the biotech stock. It just beautifully stays in sideways patterns for long periods of time, but it contains or maintains a nice upward bias. Perfect stock to write calls on. Okay, so look at the sideways pattern, mostly accumulated, unbalanced volumes going up, steady ROC, RSI around 50, not too warm, not too cold, not, just right. That's the stock you want to be selling those calls on. Okay, so let's look at number 3. Now, this is for extreme situations, and that's where you consider an inverse ETF. Right, and of course we have the S&P 500 ProShares Ultrashort S&P 500 ETF. The market's been going up like crazy. This ETF's been going down. No point in owning it. Things are starting to get a little bit different. You can see accumulation distribution is starting to go up. That means the short sellers are worn out here. Unbalanced volume is confirming that. Means buyers are coming in. No evidence of being overbought. Momentum above, ROC above 0. So money's going in here. People are concerned. You might want to look at SDS. Remember, this is a leverage ETF, which means it moves 2 times the speed or the rate or the gain or loss of the S&P 500, so it moves pretty fast. So again, you look for a topping action in the index. You decide how much of a portfolio you want to hedge with it, 10%, 20%, whatever. Allocate. Here's another thing. You can do a buy right strategy here and gain some income as you wait. If this thing starts going sideways, it's just going to be a great place for a buy right strategy. If you're really bearish, you might want to consider a naked call. So remember, when you sell covered calls, it's also known as a buy right strategy. It's best suited for flat markets or stocks and consolidation patterns, such as Gilead Sciences. It's an income opportunity because it pays a dividend. Okay, 71 cents a quarter, that's $284 a year. It's not bad, especially if the stock continues to go sideways. So it's an income opportunity. You want to pay yourself for being patient. Of course, you set those sell stops and you manage the trade accordingly. So a little bit more detail. Is the stock in a consolidation pattern? Yes. Is implied volatility well above historical volatility? Yes. 22.7 implied volatility versus 16.9 historical volatility. That's the one you want to sell the call on. Of course, you don't want to sell those naked calls. You buy that 100 shares per contract that you're going to sell and keep that expiration date for 45 days. So let's recap. When markets get shaky, it's time to manage risk. You want to look for stocks with relative strength, consider income opportunities, such as dividends, buy right strategies. If you can get a situation where you can do both, that's a double barrel income opportunity. And you want to consider those inverse ETFs if you're really bearish. But again, you can do those buy right strategies there if it moves sideways. So to decide on your best strategy, you can buy the stock or the ETF. You can do option strategies. You can do combination strategies. Or you can just stay in cash and see what happens. That's all I have for today. I'm Joe Duarte from Joe Duarte in themoneyoptions.com. Please consider a free trial to my website. Whatever you got to lose, it's free. Consider also Options Trading for Dummies now in its 4th edition. Thank you for making it #1 in the new releases. Let's see if we can make it #1 in options trading. I appreciate your support. Joe Duarte, we're going to talk again. Remember, trading is uncertain. Be prepared.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.